Do you want me to share this?
Okay, yes. Yes, again, welcome everyone. Really excited to have many of you join us today for this training. As you know, the training that we're doing is part of our QT Care. It's a program that we've started last year during the pandemic, and we're very excited to keep organizing this. So last year it was all focused on mental health and physical health. And so one of the requests that we've got from the community also is, a lot of people spend a lot of time thinking about their financial health and how they can create a more sustainable future for themselves. I'm really excited to have Jeffrey and Julien join us today for the training. Jeffrey will be our speaker today and be doing the presentation. As you see, we are going to be doing a series of webinars coming. I need to approve people as we go. We have multiple similar. Every quarter we will be bringing you a different topic. So this is going to be about 30 to 35 minute presentation. After that, we will be stopping the recording, and you'll be able to ask any Q&A. We ask everyone to come on video if you don't mind. It'll be really great to do that, and then ask any questions that you have. I also have a small survey, like a very quick 30-second survey to do after this call. We'll appreciate if you can also fill out the survey. It will help us and also help you provide good trainings. Great. And so without further ado, I'm going to pass it to Jeffrey and go ahead.
Thank you, Nafel. Welcome, everyone. My name is Jeffrey Wu. I am a certified financial planner, and my pronouns are he, him. I am super excited to be here, and as Nafel said, that we as you might have been following the socials of QueerTech, there is a whole program being built on the financial health, and today is the first webinar, and it's about the planning and building your wealth. There will be planned at least like 5 webinars afterwards and with specific topics. So feel free to go to the landing page to get to know what are they about, and also to look at the recordings of previous webinars. So we are super excited about this partnership with QueerTech because we are members of the community. So we know firsthand that even if the time has changed and the society is progressing, a lot of us still don't feel comfortable talking openly about our personal finances to a professional, because talking about personal finances meaning talking extensively about our personal lives. And that is a big problem, because like this conversation should have authenticity in it. Like lacking it in these conversations, meaning you are not getting properly advised. And bad advice and no advice creates significant barriers in our community for achieving the financial goals and to build wealth over time. And in turn, it will jeopardize our overall well-being. So by being here, like myself and my team, like the goal is to really empower the members of QueerTech community, and also to equip you with some basic, maybe advanced as well in the later stage, financial planning knowledges, so that you can plan your financial plans better. And at the same time, if you want to talk to a professional to have an open conversation, you can always reach out to any of us as well. So all the webinars will be in English and French. There will be a French webinar in a week, and all of them will be recorded. So feel free to come back to it. So I am not by myself. There are, at least there you'll see 2 more faces like in the upcoming months. Like Fernanda Cacho and Julian Balas are my associate advisors. And so as you can see, it's a very diverse, small team. We speak 4 languages. We can advise you in 4 different languages. Feel free to add us on LinkedIn, send us a message, whatever way to connect. It's totally cool. And we do share like financial related information on LinkedIn as well. So you can follow them, or you can just send me an email at jeffrey.wu@sunlife.com just to have a conversation, like to book a conversation with me or any of the Fernanda or Julian. Okay, so today's topic is called planning and building your wealth. And it is a very introduction conversation about financial planning. And it is an overarching one that can lead to different topics for webinar 2 to 6. So the goal of the agenda of today's presentation, there are 3 main parts. The first part is to how do you approach financial planning? Like how do you think about it? Like how do you define your goals? How do you reach there? The second part is like, in what investment vehicles do you save? Like we will talk a pretty extensive talking about RRSP, TFSA, RESP, and non-registered accounts today, so that you have a better understanding of what do they mean. And in the end, the third part, I will also talk about, like, if you are confused about any of the topics, or if you are too busy with your career and you don't have time to think about these, how do you seek guidance? How do you seek help from a professional? And I'll talk about like what's the process you usually go through with a financial planner or advisor, and what can you expect from that? Okay, so there's a quick disclaimer. All the information here is for general purposes, and if you need any legal, accounting, or financial advice, you do need to talk to a professional. Okay, so let's begin. So in order for you to improve on any aspect of your life, including financial, I think the first important question that you should ask yourself is, what is important to you? Like, what do you want to achieve? Without having this clear image of what you want to achieve and go into any planning conversation, is a waste of time, because in the end, like, you don't really know what you want to get. So you should ask yourself 3 questions in order to get better at this. Like, first is, where are you now? The second question is, where do you want to be? And the third question is how you will get there. So if you engage with a financial advisor or planner, usually the first meeting is all about us understanding your current situation. So it is about, where are you now? So it is about, like, what are your assets? What are your liabilities? What what is your cash flow situation? How much money you're getting in? How much money you're spending? How much disposable income you have? So those are some basic things you should really, if you're doing it yourself, you should ask yourself. If you're working with a professional, the professional will guide you. And once we know where you are now, it's important to understand what is important to you. So one thing very important to know is that advisors and planners are not there to define what is important to you. You should set your own priorities. So you could have different goals. Like, it can be short term, it can be medium term, it can be long term, it can be at the same time. For example, like, I have like many young professional clients. They're thinking about buying a condo. They were thinking about buying this. They are thinking of putting a down payment. So specific to the community, like, many of us are thinking of having children. You may need to spend money on adoption, surrogacy. You may want to start a business. For long-term goals, you may want to start to plan for your retirement and start to build your wealth. So different goals, you should have different different ways to save for them. And one thing I would suggest is to make your goals very specific to a dollar amount with a specific time frame, which will help you to stay focused and motivated. What does it mean? So, for example, like, very simple logic. If you plan to buy a principal residence in 3 years, and let's say you are looking at a condo in Montreal that's worth $500,000 today. If you want to put 20% down payment to avoid the high insurance costs for the mortgage default, then you should plan to have at least minimum 20% times 500,000, 100,000 in your bank account in 3 years. And there will be inflation, there will be legal costs, there will be taxes to pay. So maybe with some emergency fund, you should aim to have 120 around at least in your account. So by having that in mind and by understanding where you are now, you should be able to know with some reasonable rate of return how much money you need to save per month in order to achieve that goal. And then you also need to consider, after knowing how much you could put in, what do you put in and where do you put it? That's the main part of today's presentation later. But I want to first talk about the first piece of advice I will give all of you for what I just said is extremely important to start as early as possible and to make it automatic. So that's the best thing you can do is to make these contributions automatic, because it is like a little nudge for you. It is like, in the end, what changes your behavior is not your knowledge or the skill set. It's more about the environment and the context you put yourself in. So like one thing I would recommend all of you to do is to, after doing the exercise I just said, you know how much you put in, talk to your financial institution and actually start to make some biweekly or monthly contributions. So let's say you are an early stage career, like a young professional, and you don't have too much money, and you want to start to save. Like even if putting $100 per month into a registered account, like it can make a big difference over time, especially if you start early. Let's say you're 25 years old and you plan to retire at age 65. You put in $100 per month. So over 40 years, you put in 48,000, like in nominal value. And with a very conservative potential rate of return of 5%, this amount of money should have grown to close to 150,000. Meanwhile, if you start late, you start at age 55, you realize like I don't have money to retire, and you start to put, like, let's say, most likely you'll be putting more, but let's say you put 100 per month, then you put 12,000, but because you don't have the time value, like the compounding is not enough, you only end up with 15,000 in the end after 10 years. So for many of you, like you probably are high income earners, and you might have the capacity to save more. So if, let's say, you put 1,000 per month into different investment vehicles, and many of you, I'm sure you can do even more, then over 40 years, this can grow to like close to 1.5 million, and with only a 5% rate of return. So so whatever goal you have, like, I think you should really, like, even if you think it's already late, it's the earliest time is now. So start early, start to do it automatically. With the help of a professional, you should be able to reach your goals, like with the pace that you want it to be. So I see there's questions, so I will answer at the end. Unless, Nofel, if you see something pressing, you can ask me as well. But for now, I will keep going. After understanding like how much you need to save, the next question is, where do you put the money in, right? So like the number one question we got asked from young professionals about their personal savings is what registered accounts to use. So in today's presentation, I will introduce you, most likely a review, most likely you already know that, 3 investment vehicles that can be applicable to you. The first one is the RRSP, Registered Retirement Savings Plan. The second one is TFSA, Tax Rate Savings Account. And the last one, if you're planning to have kids, or if you already have kids, or if you have a nephew or niece that you really love and you want to contribute to their education, you can open an RRSP account and you can get governmental grants for education saving purposes. So I will talk a little bit about it. If you in the audience, or like people watching recording, you are already at a stage that you put fully in registered accounts because you are high income earners, you may need to look at non-registered account options. So I won't be going in depth into it today. However, keep in mind that for non-registered accounts, there are many tax planning opportunities there depending on what you invest in. So if you want to know more about it, reach out to us and we'll give you more information about that. But today we will be more focusing on the registered accounts because that's applicable to most people. Okay, so let's begin. So the first plan is called Registered Retirement Savings Plan. I assume many of you have heard about it, even maybe many of you don't know what is the best way to use it. But the idea is that the amount of money you contribute into the plan can be deducted from your taxable income, and you will get savings in tax dollars. So what does it mean the contributions can be deducted? So I'll give you a quick example. So this is if you're a Quebec resident, and this is the 2021 combined federal and Quebec personal marginal tax rates. Let's say you are high, you're making good income. You're making let's say 120,000 a year. That's your current income. And over the year, you contributed 10,000 throughout time and different investment vehicles, like let's say group RRSP and individual RRSP together, you put in 10,000. Then your taxable income will be dropping from 120,000 to 110K. So what does it mean is that the government will basically give you a refund of the 10K times the 47.46% of marginal tax rate. You should be able to get a refund of close to $5,000. Or if you did not put enough withholding tax, it means you pay less taxes. So overall, this money that you saved, you can use it in different investment vehicles for different goals, or you can use it for whatever spending that's needed. However, this is very important to know that this is only this is tax deferral, meaning you're not saving taxes, because eventually, if you need the money out from the RRSP, most likely when for a year that you don't have much income, or if you are retiring, the money that you withdraw from the account will be added into the taxable income of the year that you withdraw. However, because so this is more for like short-term and medium-term savings for taxes. One thing very cool about RRSP is the capital grows tax-free within the account. So what does it mean is that while the money is growing, while the investments are growing, let's say the money is in the account for 20, 30 years, you are not taxed in the year that the gains are made. You are taxed only when you withdraw money. So most people, when they retire with all sources of income, their income level will be lower than when they're working. So in the end, when you withdraw them, you overall pay less taxes. But at the same time, it also depends on your situation. Everything here is just for general information, because if, for example, you are very ambitious, you have a lot of passive income. Let's say I have clients that have like 10, 20 buildings and they're just getting all the passive income coming to you. Then it doesn't necessarily mean that when you retire, your income level will be lower than now. So in that case, maybe RRSP may not be you should not put like the maximum you can today, because when you will be taxed anyway. So it really depends on your situation, and it's very important to look at it in the sense that like how does it fit your situation. There is a contribution limit. So many people are so confused about like how much you can contribute. So you actually don't need to do the work, because the CRA already does the work for you. Just go to your CRA website, or just look at the notice of assessment you receive from the federal government every year. It says how much you can contribute for the upcoming year. So I'm not going to talk about how it's calculated, because you can directly get the information online. So obviously it's ideal for retirement planning, but RRSP also has two features. I think a lot of people know them, but maybe you don't know the details. You actually can withdraw some money from it for first home purchase and or continuing education tax-free. So those are the two plans that we talk a lot with young professionals. So the two plans, the first one is called Lifelong Learning Plan, and the second one is called First Time Home Buyers Plan. So the idea is that for those two specific purposes, usually when you withdraw money from RRSP, you pay taxes, right? But if you are for these two specific purposes, when you withdraw money, you don't pay tax. Of course, there's a limit, but you can save the taxes. The lifelong learning plan are for the people that plan to go back to school full time. So maybe some of you here want to go back to grad school, and if you're doing it for full time, you can withdraw up to 10,000 per year from RRSP tax free. If it's a 1-year program, you can only take out 10K. If it's a 2-year program, you can take out 20K. One cool thing about this plan is that many of you may be in common law relationships or you're married, and usually if there's a income gap between the two spouses and or there's an age difference, like one person can take out money from the RRSP to pay for the spouse, no matter it's common law spouse or married spouses, full-time education, and you can do it for each other. So a lot of people don't know that. So like if that's your situation, take a note of that. You do need to pay back the money within 10 years. You don't there's no tax consequences. You just have to ask your accountant to attribute a little bit money, so contribute a little bit money into the RSP over time, over the next 10 years if you use this program. The second one is a very, very widely used program, and I think all of you should know about it. It's called the First-Time Home Buyers Plan. So you can withdraw up to $35,000 per person. If you're married or if you're in a common law relationship, each one of you can take out $35K. So actually you can take out $70K in total to contribute for your first home purchase. So this is only for the principal residence. So you cannot use it for investment properties. And two things very important to know is that if you're in a common law relationship and you declare as common law for CRA purposes, or you are married, if one of the spouse had used this plan and you are still living in the principal residence, the other spouse basically loses this benefit. So it's important to know that. And also the money within the plan has to stay in the plan for at least 90 days before you take it out to purchase your first home. What does it mean? Is that, for example, you're walking on the street, you saw a beautiful condo, and then you check Centris and like, oh, I want to make an offer. And like, if you don't have enough money in your RSP at the time, meaning less than 35K, you cannot just lump sum put in the money and they use it for a home buyer's plan. It has to be there for at least 90 days. So you do need to have a little bit planning ahead. And talk to your advisor if you don't understand. And we will send some information about these two plans to your email post event. Okay, so how do you contribute into RSP? So many of you may work for an organization that has a group plan. So no matter what kind of savings plan it is, it can be a group RSP, can be a defined contribution plan, it can be a VRSP. No matter what kind of plan it is, some organizations, actually like most organizations, they provide some sort of matching, meaning that you can, let's say you put in 4% into the group RSP and the employer will put in 4%. Actually, I have a lot of clients in the tech field. I do know that it's usually more generous, like 6-7% is very common. So my first piece of advice is that if you haven't taken advantage of the group RSP matching, contact your HR today and open the account, because like this is basically free money given to you, because if you don't put it in, they wouldn't match. So I would suggest any of you who have the group matching option to do it immediately and start to do some automatic contributions, and the employer can put the money in as well. So the benefit of this plan is that, of the group plan, is that it is automatic. So I said earlier, like automatic is a very good nudge for you to have. And by doing a group RSP contribution, it is automatically from your paycheck. And also because there is limited investment options, and also there's no advisor associated with group plans, usually the management fee is a little bit cheaper. So you can save on some fees. This is group RSP, and there's also, so for those of you who have a group RSP, I also strongly recommend you to open a separate individual RSP. Or people who don't have options to a group RSP, you should have an individual RSP immediately. The reason behind is that most of you, I assume, you won't be working for the same employer for life, right? So like if you change employer in the future, you do need to have a place to move out your group RSP money into an account that's owned by you. So if any of you who have changed employers in the past and have pension money lying around in some financial institution that you haven't touched forever, it's time to engage with your financial professional to help you to consolidate them together and to give you a plan that makes sense to you, and you can it's easier to manage as well that way. So you can also set up automatic deductions. So a lot of people don't know that for individual accounts, you can also set up directly with your financial institution. No matter if it's self-direct or if you're working with an advisor, they can set up like bi-weekly or monthly contributions into it. And there are two other advantages that group RRSP don't have. The first one is you do have more investment choices. Depending on the amount of assets that you can invest, like most financial institutions, they have incentives sorry, not incentive, but you have the option to work with different financial institutions. It's not like you can only choose funds from one particular firm. And at the same time, like if you open individual RRSP, unless it's self-direct, you should have a dedicated advisor or financial planner helping you, so that this person can look at your overall situation and to give you some recommendations. Okay, that was RRSP. I hope I'm not too fast. But another very widely used account, and is underused from my opinion, is TFSA, so tax-free savings account. So the way it works is that you can contribute a certain amount of money. Like there is a contribution limit as well, depending on many factors. You don't need to understand what are the factors. It is on your CRA website, so just go look. So like there is an amount that you can put in. Whatever amount that you put in TFSA, it is liquid, meaning that you can get in, get out anytime, and whatever gains that you had over time, you don't pay tax on that. So so for people who are older, like that, are already 18 in 2009, like you should have close to like 80K of contribution room that you can put in. And I have personally reviewed accounts that grow since then, 2009 to now to over 300,000. So like if you really use the account well, you can make significant gains over time without paying any tax, and this room will be there like for you for in the future as well. So if you haven't thought about it, it's time to think about it, to do more research and to open one and to start to make some contributions. One very important thing to tell you is that many of the members of QueerTech are very highly educated, and you might be very confident in your own trading or your own investment skills. For TFSA, no day trading is allowed, meaning that if you are doing day trading in a TFSA account, most likely CRA will give you a fine. So TFSA is for like it's not for trading, it is for more medium long-term holding. So there are specific investments that are suitable for TFSA, but not day trading for stocks. So the conclusion is it is good for ideal for medium-term and long-term goals, and also it's also good for short-term goals because it's so liquid, you can get the money anytime. So it is good for emergency fund as well. So the action item is that if you have quite a bit of money in your checking account today, and you don't know what to do, so it might make sense to even just put in a very low risk investment within your TFSA account, so that at least you're making some returns over time and you don't pay tax on it. Because in today's world, the low interest, like if you leave the money in your checking or saving account, you basically is losing money due to inflation. Okay. So the last registered account I want to introduce you to is RRSP. I think this should be the least known one for the group because this is most people start to know this when you start to have kids. But like I believe many of you may be thinking about having kids for now or for the future, or maybe you already have kids. Or like I said, like this account you can actually open for your loved ones, your relatives. If you have nieces and nephews or whoever that you want to contribute to their education, you can do that. So the way it works is that you can contribute up to $2,500 per year, into this account. And depending on the province that you're in, you can get a grant money that's given by the federal and provincial government. So if you're in Quebec, you're very lucky because Quebec has one of the highest percentage. You actually get 30% of what you put in as a grant, and it is guaranteed. So if you put in $2,500 per year, the government will give you $750 per year. And depending on your family income, if your family income is low, there's a threshold. If it's low, they will give you even more money. So like TFSA and RRSP, when the capital is growing within the account, you don't pay any taxes. And the cool thing about RRSP is that in the future, is the kid that's taking out the money, right? And when they take out money, it is added to their income tax, not to the parents or the contributors' income tax. So let's say the kid is going to CJEP or going to university. Usually the kid is not making too much money at the time. So if you withdraw a limited amount every year, this is basically tax-free. Like you don't really pay any taxes. Like so for those of you who are thinking about having kids or about to have kids or already have kids, or you have loved ones, talk to your advisor, and it's good to have some monthly contributions into this plan because there is a guaranteed grant and also investment returns are not guaranteed, but you do have investment return over time as well. Okay, so those are the registered accounts. So the next step is for non-registered accounts. Like I said, non-registered account is usually either you have contributed a lot into registered accounts and that you have more money that you don't know where to put. So non-registered account will be the place for you. Otherwise, you really need the liquidity. So like maybe you already put enough in TFSA and you don't want to put in RRSP because you may need the money in the short term. So that way you can also put in non-registered savings. So the feature of the non-registered account is that all the investment earning will be taxed. And depending on the distributions that you receive, either it's dividend, capital gain, interest, you do get a different tax rate for it. That's why I said at the beginning that there are some tax planning opportunities here. So if, for example, you are running a non-registered account yourself or with a professional, it might be interesting to review the tax structure of your investment and to save on some taxes over time. So you receive a statement every year. You need to declare all the earnings, your tax deduction declaration. And unlike the registered accounts, there's no contribution limit. If you're a millionaire, you can put in over $1 million into account, no problem. So this account should give you a lot of flexibility for managing your finances. Yeah, so it is good for short-term goals, emergency fund, or if you max out your TFSA. If you already use your RRSP and you want to save more for retirement, you can also use this for long-term goals. Okay, so now you understand what are the options for putting the money in, right? And so the next question will be, what do I invest in? So I won't be going into details today at all for the types of investment options you have usually for a retail investor. But the next webinar, the webinar 2, will be all about investments. So for those of you who want to know more about like what kind of investment is suitable to you, feel free to register in 1 or 2 months. The webinar will be in 3 months. But just to give you a quick idea, like you can put in stocks or ETFs, you can put in bonds, you can put in mutual funds, you can put in SEC funds, you can put in GIC, you can put in annuities. So to choose the investment really depends on your situation, your profile as an investor. It depends on your age, it depends on your investment time span, it depends on your psychological profile. Some people are just more risk averse than the others. And also, of course, it depends on your goals as well. Your income, there are many factors here. So like we will have an overview in the next webinar, but not all investment types are suitable to you. And it's very important to make an informed decision of what kind of investment you should put your money into. Okay. So I'm not monitoring the chat. Like if there's not, Nofel, is there anything pressing that I need to answer, or I keep going?
No, keep going, and we'll get to the question at the end.
Awesome. Okay, thanks. All right, so this is the last part. So many of you may be confused about what does a financial advisor or financial planner do? Like what kind of conversations can you have, and what can you expect to get out of it? So today, like I do want to give you I will try to be non-biased because I am a financial planner. So like, but I will give you like an overview of what kind of conversations you can have, and also like what are the benefits of working with a financial advisor or planner. So why do you seek advice from a professional? I think no matter if you are super financial literate, like in the sense that you know exactly what I'm talking about today, and you are doing it yourself, or you don't know anything about finances and you really need someone to help you, guide you through different stages. By working with a professional will reduce your stress level regarding to your finances, and in turn will protect your financial well-being. I think I truly believe that you should let a professional, you should outsource things that you're not too passionate about or things that you're not very good at to the professional that can help you. So you can focus on what you find is very important, and also like what you really want to spend your time on. So no matter like how educated you are, like in terms of your finances, it's always good to have a second opinion and to work with someone so the person can guide you throughout the process. You can talk openly to someone you can trust outside your family and get honest feedback. So this really depends on the advisor or planner that you choose. So like I said at the beginning, like by being in the community, sometimes like we don't really feel comfortable to talk openly about our own situations. So like, at least for us, like the three of us, like our goal is that you should be able to talk about anything with us, and we will be your cheerleader and your ally in this process. But like, it's very important to choose an advisor or planner that is empathetic enough to help you, to work with you. Not all advisors or planners are created equal, so it's important for you to make an informed decision about that. So, and also like you should build a relationship for the professional for the long term, because you will go through different stages of life. You have different major life events, and the professional is supposed to, depending on your situation, to tell you what you need to be prepared in advance, because you don't know everything about like the what needs to be done at different stages. So the professional can help you in advance to prepare you for that. So that's another thing, like when choosing advisor or planner, I really think you should find someone that has the mindset of staying in the industry for long, because this is such a dynamic process and it needs to be changed. Like your situation may change anytime. If you work with someone that's, I don't know, see this career as a career transition, or like just like somewhere to work on this as a project for like 6 months or a year, it's not very beneficial to you. So you should work with someone that at least have the determination to stay for a long term, so this person can follow you throughout your different stages of your life. Okay, I'm almost done for my presentation, but like I do want to give you a quick overview of the potential conversations you can work with a financial planner, like you can have with a financial planner. And I will talk about it like with a lens that's a little bit specific to the LGBTQ2+ community. So we are very lucky we're in Canada, like because like in Canada, the tax laws and the tax system and the legal structure like are very like, how do I say it? Like they are supposed to be created equal for heterosexual couples or same-sex couples. However, there are some conversations that are important to you that you should bring up to whoever you decided to work with in all different aspects of this financial planning circle. So any financial planning conversation should start with a cash flow planning conversation, because if the planner that don't understand what are your cash inflows and your cash outflows, this person won't know how much disposable income you have and how much money you can allocate into different vehicles to achieve your different goals, right? So that's why like budgeting is very important. And also like the planner should understand different government credits, different contribution you need to make into QPP, CPP, EI, QPIP, whatever, those baskets, and what are the implications here. So in terms of the conversation with the planner advisor, we have gone through many specific items that are specific to the community. For example, like I said, like you may be thinking about saving for adoption or surrogacy, like which can cost a lot of money. most heterosexual couples may not need to plan for that expense. So you should tell the planner or advisor that, oh, like I plan to have kids like at the time, and for me, I may need to spend this dollar amount of money. So this can be taken into consideration. And there are certain medical costs or like some certain things that insurances don't cover that are specific to the community. You should also be open about it because it can have a big impact on your overall cash flow situation. So once you determine your disposable income, the next question is how to allocate it smartly. So the next circle is investment planning, which is what we'll be talking about for webinar 2. Is like depending on the profile as for you as an investor, you should choose products that are suitable to you. So this is all about understanding your risk profile, understanding your goals, understanding your family status and things like that. Like it's like the know your client process should not be just going through one questionnaire. It should be an open conversation. And so the advisor can really understand what are your priorities. So if, for example, you work with an advisor and this person, without asking any questions about you and just provided like a mutual fund or whatever product to you, that's usually a red flag. That usually means this person is just trying to sell you something. So it's important to have these conversations before the professional make any recommendations. The third basket is insurance planning. I think this is the least sexy one to most people. However, it is very important. I think like I personally know many people like personally that got sick unexpectedly or like there's a loved one dying prematurely, and many of them have liabilities or many of them have responsibilities that they need to provide for finances over time. So our third webinar will be, the name is Can You Afford to Be Sick? So we will be giving a very comprehensive overview of different like government provincial healthcare like programs, like what do they cover, and also to talk about like different kind of insurances that you can consider to protect you and your loved ones. And insurance planning also can be very advanced, like for business owners in the call, or if you're watching recording, or if you're a high income earner, you can see life insurance as an asset class as well, and there are some tax planning and estate planning opportunities there. But that is in-depth stuff. So like if we can talk about it if you want to know more about it. The next one is tax planning. So this encompasses everything I just mentioned, actually. Like you should work with your advisor or planner to understand what are the tax implications for doing different things. And for if you have non-registered accounts, like how do you invest to make it more tax efficient? And there are certain tax credits, there are certain programs that you may not be aware of, like the advisor or planner should be able to advise you on the planning side. And lastly, the retirement planning and estate planning. Those are the two biggest basket that the planning topics that we usually have with clients. I know many of you may be very young and you don't think retirement planning and estate planning are important to you at the moment. But as you saw in my previous slide, if you start to save early for these purposes, for these long-term goals, you'll thank yourself in the future because you took care of it early in life and you have much less stress at the time. Specific to our community, what I see for estate planning, very important to know is that many of us are in common law relationships, and so there are different tax laws regarding common law relationships for Quebec and the rest of provinces, depending on the province. But if you are a Quebec resident, like we follow the civil law, right? So what it means is that if you are in a common law relationship and the person, one of you passed away without a will, then the other half won't be able to inherit the wealth of the other person. Maybe you build together over years, but the law is that if you don't write it clearly in the will, you won't be getting that. So so it's important to draft your will and power of attorney well, and to specific to your situation, so that we can have a conversation about this if you want to know more about it. Sorry, I just realized that I spoke a lot. So so like I will finish now, but like there are, so one last slide, 1 minute, is that when you engage with an advisor or planner, you should plan at least 3 meetings with the person. 1 meeting is to get to know more, like the advisor will have a discovery meeting to understand your situation or your goals. And the second meeting is about analysis and recommendations. And the third meeting is about transactions and about the implementation. And this is supposed to be a dynamic process, so it should be reviewed over time, at least once a year, or if you have major life events. Okay, so that's it. So this is the first meeting, sorry, first webinar, and I hope you liked it. You can reach out to us, and we will also send you a post-event email with some of the information I just talked about. Okay, thank you, Nofel. I'll go back to you.
Wonderful. Yeah, thank you, Jeff, for all the amazing information. I'm just going to go ahead and stop participant sharing. And yeah, this was really wonderful. So thank you so much. We do have a question. So we'll take about 10 minutes to answer some questions. If other people have other questions, feel free to either add them on the chat, or you can also intervene. The first question we had was, does RRSP give you a tax break? So when your kids who pays, are the kids who pay for like the taxes when they withdraw it, like RRSP, or how does tax work when who pay for them?
So for RRSP, the amount you put in is not the tax deductible, meaning it's not, you cannot deduct it as like RRSP. However, like the growth within the account, including the grants that you received, it is